All right, welcome to the live. Albert Liu here today with special guest Paul Harris and Rick Rule. And today we're going to be having a discussion on the oil and gas industry. So, Paul, first of all, welcome to the Rule Classroom. This is your inaugural appearance, and actually was the first issue of the newsletter that you and Rick recently launched. So, very exciting news. Welcome to the classroom.
Well, thank you very much, Albert. Pleasure to be here.
Okay, so in the description of this event, below the live stream is the newsletter, the first edition of your newsletter. And if you're joining us on YouTube or Twitter X or LinkedIn, I suggest you may want to come over to Rule Classroom at ruleclassroom.com, sign up and view the program here if you want to see the document that Paul will be referring to during this discussion. We'll also try to put graphics on the screen to help you out a little bit. So welcome. Rick, this newsletter was your idea. So tell us about, I guess, the genesis of this project, why you think it's important, how it fits into what we do here at the classroom and the symposium and the boot camps. Go ahead, let us know what this was all about.
The genesis is really threefold. As you know, Albert, I've been grading portfolios for people for 25 years. Anybody who wants can go to ruleinvestmentmedia.com, list their natural resource stocks, and I will, for no obligation, grade them. Complete money-back guarantee, given it is free. Doing that for 25 years, I've learned an awful lot about how people invest. And the impetus for both the newsletter and the Real Classroom is to help people become better investors. Applying the lessons that I've learned, looking at the mistakes and successes that people have enjoyed over 25 years has helped me a lot. We built up a very large audience, Albert, you and I, and we need to speak to that audience more frequently. But I needed help speaking to them. And I've been reading other people's investment letters for very, very, very long time. And I decided that I could be part of a letter that was at least as good, if not better, than most of them. And I decided that the right beneficiary of that should be my existing audience. If we write a letter and we charge a lot for the letter, it's incumbent on us to try to satisfy individual market niche needs of the letter. Whereas what I wanted to do was address the general needs of the larger Rule Investment Media and Rule Classroom audience. As you suggest, Albert, the letter itself is meant to illustrate broad investable themes and teach people how to invest, while at the same time providing investment opportunities for them to look at and decide on, utilizing the tools taught both in the letter and at the Rule Classroom. But make no mistake, this is meant to be an interactive medium. The letter will talk about broad themes, the letter will talk about specific companies, but these are not meant as individual investment suggestions or picks. What they're meant as suggestions that people can research further and determine whether or not, hopefully utilizing the lessons that they learned in the Real Classroom, to determine whether or not these investments fit in their portfolio. I've known Paul Harris and watched Paul Harris for a very long time in other venues, and thought Paul, because of his technical skills, his writing skills, and his entrepreneurial acumen, that he would be the ideal partner in this letter. And I hope that the interaction between Rule Investment Media, the Rule Natural Resources Investment Symposium, the classroom, and the letter is fruitful for all concerned, but in particular fruitful for the 70,000 odd people that will receive the letter.
Yeah, and this has been a highly requested topic, Rick, among subscribers to your email updates, as well as people who are regular members of the online platform that is Real Classroom. So I think there will be quite a bit of excitement surrounding this, and I feel I'm very glad, very proud to be at least delivering the first installment of something that people have been asking for a very long time. So Paul, why don't we give you the floor? Perhaps you could just walk through, for the people who didn't maybe perhaps receive the letter but didn't have a chance to go through it thoroughly, maybe walk them through, what you're thinking, the thesis, and then we'll take questions from Rick and also the online audience.
Okay, thank you, Albert. As Rick mentioned, the idea behind the Rule Investment newsletter is to outline broad, high-level investment themes. These will often be contrarian and value-oriented themes based on Rick's 50 years of experience in finding resource opportunities. And in the letter, we will sort of dig into the rationale and the logic and the case behind each theme that we address with each issue. Now, as you mentioned, Albert, the first one we're going to look at is oil and gas, and specifically Canadian oil and gas opportunities. Oil and gas in general has fallen out of favor to a certain extent in recent years because of energy transition, the energy transition narrative, people looking to decarbonize everything, switching out oil and gas for electrical energy, whether that's hydro, solar, wind, or whatever. But we believe that oil and gas are not going to disappear anytime soon, and humanity is still quite away from reaching peak oil demand. So we still see there's a significant opportunity in the oil and gas space. Now, why are we focusing on Canadian oil and gas stocks with this first newsletter? Oil and gas is obviously a very politicized group of commodities, and that has never been further from the truth or closer to the truth than this day and age, with the geopolitical tensions caused by US President Donald Trump and the rest of the world's response and reaction to that. Now, Canada's former Prime Minister, Justin Trudeau, he was very much a flag carrier for the Green Revolution and sought to deprioritize Canada's oil and gas strengths. He didn't really understand or didn't see or value the business case for the export of oil and gas from Canada, despite the fact that such products are often sold for less than $2 per million BTU. That gas, when landed in Rotterdam, Tokyo, Shanghai, elsewhere, fetches 14 Canadian dollars per million BTU, although it just takes $3 to $4 to get that gas liquefied. There's potentially very big profit margins there that the former Prime Minister of Canada, turned his nose up at or chose to ignore. Despite those attractive economics, Canada's key trading partners of Canada, Japan, China, Germany, they're begging for gas. Germany in particular, with its shutdown of its coal-fired power stations and the closure of its nuclear program as well, means it is energy vulnerable and scrambling to fill those gaps. Now, let's bring in President Donald Trump. He's always been a proponent for developing the oil and gas sector. During his first term, he was a proponent for drilling in the Arctic off the Arctic Ocean off Alaska, and in this term, we see similar themes there. And we believe that President Trump is looking to ease a lot of the regulatory burdens on developing oil and gas, and in particular oil and gas infrastructure, which will both benefit the US and probably potentially oil and gas opportunities in Canada. There are quite a few wrinkles to that, given some of the executive orders and other noises he's made since taking office in January. Next week, for example, we have what he's dubbed Liberation Day, April the 2nd, when he may or may not implement a whole raft of tariffs, import tariffs, particularly impacting Canada. So there's still a lot of balls up in the air. It's a very fluid, dynamic environment politically. Now, President Trump said that he supports the debottlenecking of the Keystone Pipeline, which, if that occurs, could help facilitate the transmission of Canadian heavy sour crude to Gulf US coast refiners that are tooled up specifically to use that feedstock. They originally tooled up to get that feedstock from Venezuela. That is no longer available. There's also a broad market fear about tariffs and what that will do to drive energy prices. And so we see a good opportunity there, depending on how tariffs and other things play out. That could provide a real boon, a real boost, potentially even a spike to some energy prices. So the combination of opportunity and the generally undervalued nature of the industry, the need of frontier markets for access to politically reliable and secure sources of hydrocarbons, the removal of domestic political opposition. We see all these things as positives. Now, the fly in that ointment, to some extent, we thought would be Mark Carney becoming Prime Minister of Canada. With the resignation of Justin Trudeau, he was nominated and succeeded him. He's called a snap election, which will be on April the 28th, just over a month from now. And we initially regarded him continuing in the Prime Minister's role as being negative for this thesis. But the executive actions of President Trump in the United States has seen we've seen Mark Carney respond to that with some initiatives that are potentially quite positive for Canada's oil and gas sector as well. So that for us is a positive surprise. And some of this is, as I mentioned, it's a rapidly moving, fluid environment. And some of these changes have happened in the 2 weeks since we put out this first edition of the Rural Investment newsletter. For example, last week, Mark Carney, he called together the premiers of all the territories and the provinces in Canada to hammer out what he called a one project, one review policy, whereby infrastructure projects, including mining projects, including oil and gas projects, won't have to go through both provincial and federal permitting. One permitting process will be enough. He also announced what he called the First Mile Fund, which will be a capital investment fund in infrastructure, which could be roads, could be transmission lines, could be power lines, it could be pipelines. The basic thesis there is for the federal government to put funding in place to help develop the critical infrastructure that natural resource projects in remote locations often lack, or it often costs them hundreds, if not billions of dollars to put into place. So a fluid situation, but we see a lot of positives there. And that was the general thesis that we had behind the Canadian oil and gas industry. And we're not focusing on the absolutely giant companies. We see sort of better leverage in some of the smaller, less loved, more inefficiently priced companies. And in the first issue of the newsletter, we introduced a number of those. I think there's 8 or 9 of those that we think will be some of the best opportunities in the space. Now, the companies we selected are involved across the portfolio of hydrocarbon products, from crude oil to light oil, natural gas, condensate, and so on. Some are focused on specific basins. Some are vertically integrated throughout the value chain and include refining and even, gas stations. There are also some royalty companies in there. One of the things that the readers of the newsletter will see is that many of the companies pay monthly or quarterly dividends and have active and aggressive share buyback programs. So their returns to shareholders policies are very aggressive, much more so than companies in the mining and the royalty streaming space, for example. And so in addition to share price growth, we see the opportunity for monthly, quarterly dividend growth as well, which obviously both those aspects are attractive to different sets of investors. And I'll just go through the list of companies we identified in the report for to invite our readership to take a closer look at. They are ARC Resources, Birchcliff Energy, Canadian Natural Resources, Freehold Royalties, International Petroleum, Peyto Exploration and Development, Prairie Sky Royalty, Suncor Energy, and Tourmaline Oil. And Albert, can you put up the other graphic I sent you, please? Yeah, this is basically a very sort of crude table of them, and this is data that from about half an hour ago. Here's the names that we mentioned in the report with their tickers, the share price movements, and the column on the extreme far right where you see the purple, that shows that the companies that are trading within 5% of their 52-week highs. So these companies that we've identified, they're trading very well. They're trading at near 52-week highs. Most of them are very close to that. The ones that aren't are very close to that level. And we expect these to sort of continue to sort of grow and prosper as the political narrative continues to evolve. And with that, maybe I can defer to Rick for some additional comment on that.
Thank you, Paul. By the way, great opening spiel. You were born for this. I myself was attracted to Canada for a couple of reasons. First, I've participated in the Canadian oil and gas business since the middle part of the decade of the 70s, so I'm quite familiar with it, quite comfortable with it. Secondly, because of the political headwinds around Canadian oil and gas, and because the market is less efficient and less liquid, those names are cheaper than comparable U.S. companies, and cheaper appeals to me. I believe, too, and this is a controversial belief, that the United States, in terms of easily accessible, increasable natural gas production, is approaching our productive capacity peak. I say that because the excess U.S. gas production that's occurred has come as a consequence of byproduct gas production from oil drilling, particularly in the Permian Basin. Industry sources that I'm in contact with say that we have drilled between 85 and 90% of our Tier 1 Permian locations in the United States, which means that the great production increases that we've seen out of the Permian probably peak in 2025 or 2026. And as a consequence, byproduct gas production decreases too. The comparable numbers in Canada are that the industry appears to have drilled only about 50% of its Tier 1 locations and spent a lot less money on identifying locations, which is to say the production growth headroom in front of us in Canada is much higher than it is in the United States, while the beginning of the de-escalation, if you will, of U.S. gas supply firms up gas markets in the United States and abroad. I think that's very important. The fly in the ointment, as suggested by Paul, is, of course, Canadian politics, particularly in the form of Mark Carney. Carney has been no friend of the energy industry. It's ironic that his campaign right now is a campaign around change, given that he has been primarily responsible for the attitudes of the Canadian government for the last 10 years. A change from Carney to Carney seems to be what Carney would prefer. He has taken, as Paul suggests, a couple of energy-friendly steps. The first thing that he's done is suspended the highly unpopular carbon tax, where he was attempting to change Canadian consumer behavior by taxing their utilization of hydrocarbons. Note that this tax wasn't revenue neutral either. He didn't try to offset the money that he stole from Canadians via carbon taxes by reducing other kinds of tax. This was just an add-on tax. While I suspect that he still likes the goal of the Canadian carbon tax, he also wants to be elected Prime Minister of Canada in a month. And that tax was unpopular enough that he took it out of place. If there's good news around the ascendancy of Carney, and I'm not sure there is, but if there is, the good news would be that unlike his predecessor, Mr. Carney can add and subtract. He ran the Bank of Canada, albeit poorly, in my opinion. He ran the Bank of England, albeit poorly, in my opinion. He was and has been an important business executive, including at Brookfield, one of the largest developers of infrastructure projects in the world. He operated at the conjunction of business and government and has for a very, very, very long time. While his predecessor would not have seen the business case for Canadian oil and gas, despite the fact that customers were begging for it, Mr. Carney will. Whether he chooses to put Canada's economic future and their chance of balancing the federal budget ahead of his own ideological anti-energy stance remains to be seen. We've seen politicians do stranger things, which is to say, implement policies that they in particular didn't like because their hunger for power was greater than their belief in principles. And one can only hope that Mr. Carney is cynical enough that his ability to add and subtract in his quest for power causes him to do the rational thing around Canadian oil and gas. I realize that that's a very, very, very weak point, but it's a point nonetheless. It's instructive to watch the performance of the Canadian oil and gas industry in the last 6 or 7 years against extraordinary political headwinds and very weak commodity prices driven both by the excess of supply of U.S. natural gas and also by the constraints, both politically imposed and bottlenecks around the transmission of oil and gas out of Canada. Despite this, and despite ugly political headwinds, the Canadian oil and gas sector has generated substantial excess cash. Much of the cash has been returned to shareholders, which is to say the Canadian oil and gas business has been decapitalizing itself, sending more money back to shareholders by way of dividends and share buybacks than probably would have been justified anyway. They have been deferring sustaining capital investments in many cases, which is to say the companies have been cannibalizing themselves. But the companies that have been presented to you in this letter, with 3 exceptions, have not been part of this decapitalization process. And even the companies in this that have been decapitalizing have done so maintaining tier 1 locations and turning on the drilling budgets when it was appropriate to do so. So it's important to note that the Canadian oil and gas business has operated well against a lot of headwinds, is generating substantial excess cash, and has been polite enough to distribute some of that excess cash back to shareholders. We expect that to continue in the future. We expect, too, that to the extent that the Canadian oil and gas industry has the ability to redirect more of the cash flow into growth, that the headroom for growth in Canada relative to the United States is truly extraordinary, with perhaps 3 times the relative amount of undrilled tier 1 locations available to them, and in addition, with more upside associated with absolute rank exploration. This is a very, very, very good investment theme. I remember many years ago, 40 years ago, probably writing an investment letter talking about yield investing rather than growth investing. The name of the letter was Yield or Growth, Why Not Both? And the Canadian oil and gas business currently gives you the ability to make an investment where you don't have to decide between yield or growth. You get great current yields, both by way of dividends and also by way of share buybacks, in an industry that is generating enough cash to make the reinvestments necessary to maintain these cash flows for 5 years and 10 years and beyond. Your decision as an investor is really twofold, I think. What is the probability of a global recession over 5 years or 6 years or 7 years that reduces demand for hydrocarbons on a global basis? You can have shortfalls in supply, which in the oil business we will definitely have. And if it's coupled with a shortfall in demand as a consequence of recession, prices don't have to go anywhere. Otherwise, however, prices have to go up. The International Energy Agency suggests on a global basis that the cost of producing a barrel of oil, fully loaded, not just the lifting cost, but fully loaded, which is to say the cost of capital and the social costs, rents, taxes, stuff like that, exceeds $60 a barrel. The consequence of that is that the oil industry globally is underinvesting in sustaining capital investments, which will, within 2 to 3 years, impact their ability to produce. Absent a recession, we can expect higher hydrocarbon prices then than we have now. And we can expect that the Canadian industry is better positioned than the American industry to capture that arbitrage if politics are willing. Politics, of course, being the second caveat. The first caveat was a recession. The second caveat is Carney. It is worthy to note that in Canada, what I call the consolidated left, the Liberals, the NDP, the Greens, and the Bloc Québécois, regularly command between 60 and 62% of the Canadian vote. It is not unlikely to assume that the Liberals will either win an outright majority, less likely, or form a minority government, which would lead to some form of the continuation of the anti-oil regime that existed through the Trudeau days. My suggestion to this is that investors with a longer time frame may be able to survive this shortcoming, that the value in place probably discounts the shortcoming, and that there is a chance, a hope, that Mr. Carney's competence in arithmetic and his need to increase government revenue means that he becomes less hydrocarbon unfriendly than one might suspect. Sorry for that long-winded soliloquy, but that is my sort of opening statement, if you will.
All right, can I just jump in here for a sec? Many people have joined us since the start, so I just want to reintroduce Paul Harris, editor of the new Rule Investment Media. newsletter, who is joining us today to discuss the first installment, which is a treatment of the oil and gas industry. Rick, we have a lot of people on here on the stream and some class members begging you to give the squeaky pen, a break. You're working it really hard today. Some funny comments. Mark says, you may not hear it, but I do. But soon, due to age, will not hear either. But trust the youngsters hear it very well. So thank you, Rick, for that.
For our audience of dogs. Yeah.
An audience of dogs. Exactly. So we have many more people joining us now since we started. Invite you to come to rulclassroom.com, where we have posted Paul's newsletter along with this live stream. If you're interested in taking a look at not only the picks, but the charts and the reasoning behind it. Paul, Rick, where should we take the discussion from here?
Well, we can take it. I think we can take it anywhere the audience wants. It's important to note that we hope to have discussion, a general discussion like this in the Rule Classroom for every edition of this newsletter. One of the things that I've noticed about other people that publish newsletters is there isn't enough ability for the readers of the letter to interact with the editors of the letter and to make the program truly interactive. Beyond that, I'd like to see the users form independent discussions groups within the Rule Classroom so that they employ the lessons learned in the Rule Classroom and the lessons in the letter and develop a community discussion. So I hope that occurs. Now, further to that, I think we can take this discussion anywhere, Albert, that you want it, or Paul wants it, or more specifically, the audience wants it, with the caveat that if there's 2,000 people watching the live stream, there's likely to be 7 or 8 answers where we're going to have to say, we don't know, by way of answer.
Yeah, that's fine. Let's go to some of the questions then. So put your questions in the comments.
Albert, can I just jump in with a question or a discussion point first? Obviously, Rick, in your comments, Carney was, most of your comments about Carney were very negative. But given the evolving situation between Canada and the US, the possibility of the big tariffs coming in next week, Trump's put in a 25% tariff against automotive imports. There's tariffs on aluminium, both things that Canada supplies to the United States. If Canada's economy has a big hit, oil and gas could potentially provide Carney with a sort of get out of jail free card. And politicians are nothing if opportunist. And as you mentioned, are quite willing to sacrifice their principles for votes. What's your thoughts on how that could potentially play out?
Well, I think that's a very important point. Opinion polls in Canada show that more than 80% of the population of Canada wants the economic benefit of oil and gas. And I suspect that Carney is aware of those polls, and he's probably aware of the fact that if he doesn't heed them, and if Canada's economy is negatively impacted in a trade war with the United States, that he will be held responsible for not dealing with that. He is nothing, as history shows, if not pragmatic. My own belief, too, is that Mr. Trump is probably picking too many fights with too many people simultaneously, that there's likely more sound and fury than there is reality. My suspicion is, at least over time, and when I say time, I don't mean decades, but rather months, that cooler heads will prevail and that there will be a political resolution to many of the trade disputes between America and its business partners, the closest of which and the largest of which is Canada. My own belief is that Mr. Carney is a greater threat to the Canadian oil and gas business than Mr. Trump, simply because he's closer. I've learned in 50 years of investing that the most dangerous politician to be is the one that's closest to me. And for the Canadians, that's Carney, not Trump. But as you suggest, it might be that Carney will need to be more pragmatic as a consequence of Mr. Trump than he otherwise would be. My primary thesis around the Canadian oil and gas business is simply that it's such a superb business and it's so cheap. I'm willing to take those political risks.
Thank you, Rick. You're on mute, Albert.
Albert, you're muted.
Albert, you're muted.
Oh, that was so good too. Okay. Can I ask this first question regarding political risk, Rick? And that is, you mentioned a fly in the ointment, but I feel like maybe there's a giant fly swatter waiting a little bit beyond that. And that is, you have a double political risk. You have the United States, big brother to the south, to deal with. The United States doesn't seem too keen on, for instance, the Germans consuming Russian energy. I'm wondering how excited they would be about the Germans or Europeans or even China consuming Canadian energy.
My suspicion, although obviously I don't occupy any part of Mr. Trump's brain, would be that increasing Canadian natural gas exports to China, Korea, Japan, and Germany, particularly if it's done partially in conjunction with U.S. firms through U.S. liquefied natural gas facilities on the East Coast and West Coast of the United States and transmitted through U.S. pipelines, would be preferable to gas with a more overt enemy with no U.S. economic nexus. It's important to note that as a consequence of Mr. Trudeau's failing to see the business case for Canadian oil, natural gas exports, that there is no liquefied natural gas export facility on the east coast of Canada. And so to the extent that any natural gas cargoes from Canada went to Europe, they would first have to travel through U.S. pipelines, and they would have to be liquefied on the U.S. Gulf Coast or the U.S. East Coast. This would inure to the benefit of the U.S. oil and gas industry, which thus far has been fairly strong supporters of Mr. Trump.
Okay, great answer. Thank you for that. Question, let's see, first question in says from S. Adams, Rick, you made a number of optimistic comments on Canadian oil, but he or she wants to know, why would Canadian oil do better than U.S. oil? He goes on to say Canadian PEs do not look that cheap and dividends do not look that great.
The case is that the Canadian oil and gas business is effectively decapitalized for 6 years. Rather than assume the political risk, the Canadian oil and gas business has deferred sustaining capital investments and made distributions to shareholders. The possibility exists now with the plateauing of at least Permian Basin natural gas production, and the possibility that U.S. transmission, storage, and export facilities open up to Canadian hydrocarbons, that will reverse itself. The Canadian oil and gas business on an earnings basis is not cheaper, but on a recycle ratio basis and on an exploration production upside basis is much, much, much greater. And that's really the business case. The unsung beauty of the Canadian oil and gas business is what's called the recycle ratio. The recycle ratio has to do with the amount of new net present value by way of reserves that can be added to the balance sheet by the margin generated by a produced barrel. In other words, if the profit margin generated by a produced barrel through either acquisition, development, or exploration yields 1.2, 1.3, 1.4 to 1 barrels, let alone like 2 barrels. In other words, if you have a dramatically positive recycle ratio, you have a business that can satisfy both the shareholder demands, but also continued production growth. The number of undeveloped locations in parts of Alberta and British Columbia with transmission infrastructure suggests that when the Canadian, or I should say, if the Canadian oil and gas business begins to feel like they have some tailwinds as opposed to headwinds, that the recycle ratios in Canada will become extraordinary. The recycle ratios in the United States have been good, in fact, very good, as a conjunction of various technologies, three-dimensional seismic, measurement well drilling, horizontal drilling, multi-stage fracturing. This combination of technologies over the last 15 years have led to a tremendous boom in production. That same boom in production, that same very strong recycle ratio means that the United States is rapidly running out of tier one locations. A second challenge that the United States faces, at least in the Permian Basin, is a developing challenge with regards to the disposal of salt water. Our ability to produce oil and gas has grown so fast in the Permian that it's outstripped our ability to re-inject produced water. And while I don't consider that to be a game-changing threat in the next 2 years, the industry has to think in the 5 or 6 year time frame. The Canadian industry is much less challenged by that because they're much less overdeveloped than the U.S. is. So the competitive advantage in terms of onshore domestic production in North America swings from the U.S. producers who've enjoyed a huge advantage for 15 years, I think, to the Canadian producers.
A very illuminating answer. Speaks to how good of a question it was. So thank you for that question. Rick, we had a discussion in the classroom yesterday with Adrian Day about dividends and how, even though we all love dividends, I think that continuous compounding is really the key to generating massive amounts of wealth. And I think you would take a good recycle ratio over a dividend any day, wouldn't you? Am I right?
I absolutely would. I'm a total value guy. You need to understand in a business where there's built-in declines that the deferral of sustaining capital investments impedes, sometimes permanently, the ability to generate dividends over the longer term. You need to reinvest money to maintain production 3 years from now, 5 years from now, 6 years from now, 10 years from now. And that's where those dividends come from. You look to companies in the oil and gas business with a record for capital efficiency and a record for making and increasing sustaining capital dividends, like ExxonMobil as an example, to develop what becomes, in effect, dividend machines. We're beginning to see dividend machines in Canada too. Tourmaline being a wonderful example of growing the company while being generous with shareholders. And one of the smaller companies on our list, International Petroleum, becoming a real dividend machine in Canada while maintaining their ability to meet or increase production going forward.
Next question from Aiden. Rick, what are your latest thoughts on the midstream in the context of current geopolitics?
That's something I'm studying, and I don't have enough of an opinion to make a comment yet. Certainly in the United States, the incredible capital investments made by the midstream industry speak well for their ability to generate generous dividends over the next decade. Looking beyond that, I'm unprepared to comment.
Okay. We got a couple of questions about Freehold. Breton asking your thoughts on the leadership. And Patrick also asking about Freehold versus Prairie, I think, PSK.
Freehold has been the underperformer in that portfolio. I own Freehold, because of my longtime familiarity with the asset base and the ability to enjoy the benefits of other people's capital contributions. There are suggestions that from time to time Freehold has overemphasized distributions and underemphasized acquisitions. There is also criticism of their merger and acquisition activity in the United States, where it's arguable have less of a definable business advantage. When I look at the enterprise value of Freehold relative to my estimate of the net present value of Freehold, it's too cheap and the assets are too high quality for me to ignore.
Rick, are any of these the type of company that Warren Buffett says, not to disparage anyone, but he says an idiot could run them? Are any of them so good that the leadership doesn't matter as much? Because we're talking about capital allocation here. That's a very important function in a lot of businesses.
I don't think so. A business by its nature gets smaller. A business where you have to fight depletion every year and you have to make intelligent capital allocation decisions every year is not a business, sadly, that can be run by idiots unless it is too cheap. Buffett made the decision in the middle of COVID that the circumstances that we were facing were one-offs. You'll recall that the oil price briefly went negative, which is to say that some oil producers had to pay people to take the oil away. But Buffett looked at the fact that the selling price for oil evened out at $20 a barrel, while the industry average total production cost worldwide was $60 a barrel. And he asked himself a simple question: would the oil price go up to 60, or would his car not start? Those were the only two choices. He made the right decision, and he allocated to the industry. He allocated really three places. He allocated to ExxonMobil, then exited the position. He allocated to Chevron, and he allocated to Occidental, which he believed, as a consequence of its balance sheet challenges, was the cheapest of all, knowing that he himself could fix the balance sheet challenges. I don't think he made those investments because he believed that they could be operated by idiots. I believe that he made the investments because he believed that he was buying dollar bills for 20 cents.
Okay, yeah. If his car ever stops working, Rick, I think it'll be because it's too old, from what I've heard. not because there's no oil. Okay. Question: are all Canadian oil and gas companies viewed as hostile by the same green movement, or is tar sands like Suncor Energy considered to be more carbon polluting?
Yes, I would say that Suncor is viewed the most hostilely of all those names. One of the reasons why I like it so much. They benefit from upfront capital investments so that their sustaining capital investments become less critical than a high-frequency driller like a tourmaline. But as a consequence of the fact that at least part of their operation is oil sands mining, which requires the burning of hydrocarbon to generate the power to extract hydrocarbon, they have the largest carbon footprint relative to hydrocarbon production of any of the companies that we've talked about. They also have extraordinary recoverable reserves per share, meaning that the exploration risk there for the next 30 years is nil. Gradually, their operations transition, and I say very gradually, from hydrocarbon mining, oil sands mining, to steam-assisted gravity drainage, where the industry goes after deeper reserves by doing what is in effect a steam flood, introducing steam into the formation rather than moving the oil through the rock. While this is still carbon generating, it is less carbon generating than oil sands mining, and also presents much less surface disturbance.
Yeah, here's a conspiracy theory for you, Rick. There's only so much hostility to go around in the world, and with Elon and Tesla attracting so much, maybe some of these other guys will get a break. Hide your Tesla.
I have no comment.
Okay, Michael, with the value inherent in these stocks at this time, what is Rick's guidance for size positioning?
You know, people ask me questions like that, and there is no one size fits all. At my age, the circumstance where I get some of my yield now, and where I get some downside protection from the current yield, and also from the discrepancy between price and value, I'm less about leveraged upside than I am about certainty to upside, and having some of my cake while I eat it too. So for me, these are very high quality names. And for me, they absorb a fairly large portfolio allocation, and a portfolio allocation that will likely grow depending on the hostility exhibited by Mr. Carney. There are other investors with a more speculative orientation who are looking at the possibility of 5 baggers or 10 baggers or 15 baggers that won't be attracted to names like these, that won't be attracted to current yields. There are other people who are even more risk averse and don't want to take compound political risk, that would like to, as an example, play the natural gas thesis by buying Equitable or Devon, 2 high quality US names. I get all that. The answer to the question is that there really isn't any one size fits all, and people need to ask themselves what their risk tolerance is, what their time frame is, what their reward expectations are, and construct their own allocation decisions.
Yeah, I mean, what would your approach even be, Rick? What's say like the first 3 questions you would ask someone if you were trying to answer this question?
How important is upside to you relative to downside?
Okay.
How patient are you in terms of when you might expect the upside? And how much of your reward do you need to see, or would you like to see, by way of return of capital and dividends?
Yeah, and then the question 2, Rick, if question 2 was a multiple choice question, what would the 3 answers be in terms of time horizon?
I suspect that anybody who has a 1 year or less time horizon avoids the sector. I think the big unanswered question is Carney, and I think we'll have the beginnings of an answer in 6 months.
Very good. Okay.
I'm willing to take the risk for 6 months because I have a 5-year perspective, and because this portfolio yields me so much down protection as a consequence of value, and also so much income by way of dividends that I'm willing for a reasonable allocation to take the time risk and the Carney risk.
Okay. Kind of a long question regarding marginality or optionality in the oil sector. So I won't read the whole thing, but basically the questioner is saying sees a lot of companies with sustainable dividend policies and great valuations at the $65 to $70 per barrel range. But that changes at sub 60 quite dramatically.
It does.
So why are we seeing this like hypersensitivity to the oil price around there?
In the oil and gas business, because of the relatively high reinvestment requirement, you are extremely price sensitive. Remember that when most people look at the costs in the oil business, they figure out two things: the discounted capital cost, which is to say maybe it costs you $1 million to drill a well, and maybe that well delivers $3 million worth of oil over 10 years. And then there's the lifting cost. But there are other costs, which is to say the recycle cost. First of all, of that $3 million in a modern well today, a fracked well, a lot of the benefit comes back in 18 to 24 months. But the consequence of that is that you're constantly having to drill to maintain production. The consequence of all that is that when you add the third cost in, depletion, when the International Energy Agency suggests that the all-in cost to produce a barrel of oil, by the way, this includes taxes, royalties, and the cost of capital, is $60 a barrel. When you get below $60 a barrel, for many producers, you're really challenged. You will note that the basket of producers that we have chosen are on a full cycle basis. Lifting costs, capital costs, and then cost of capital and total costs, easily in the best quartile in North America in terms of production cost.
Question about Greenland, Rick. Is Greenland strategic for Canadian gas?
No. I mean, Louisiana's more strategic. Right now, if you're shipping natural gas to European markets, you have to ship the gas through U.S. pipelines to Gulf Coast or East Coast liquefied natural gas facilities. I say Louisiana, meaning Louisiana, Texas, Florida, Georgia, where the LNG facilities are in the U.S. East Coast. Hopefully, at some point in time, perhaps because of the importance of the Quebec vote, an LNG facility will be established somewhere east of Montreal, facilitating a Canadian transition route for the sale of Canadian hydrocarbons. There has been some progress in Western Canada, in the province of British Columbia, where liquefied natural gas facilities have either been built or are approved and under construction. So there will be, irrespective of Eastern Canadian politics, some increased ability to access Asian markets for gas from the Western Canadian Sedimentary Basin, both through the Lower Mainland and also through Prince Rupert in BC.
How long would it take to get that kind of infrastructure in place?
Well, with regards to two projects, they've been under construction and have been financed for some time, and we would expect the beginnings of the debottlenecking of Pacific infrastructure to occur in 2025 and 2026. The Eastern Canadian link, that's a different story. I mean, the first thing that you have to do is suffer through both federal and Quebecois policy. Ironically, to transport the gas from Western Canada to Eastern Canada right now, you need to go through the U.S. mid-continent. a truly ironic circumstance where even the establishment of East Coast liquefaction facilities would require the transshipment of major amounts of Canadian natural gas through U.S. infrastructure. Hopefully the Canadians see fit to debottleneck that.
Well, at least they only need one permitting process now, Rick, in Canada.
I'm sorry?
At least there's only one permitting process now in Canada going forward.
Well, understand that's perspective. I mean, everybody's agreed to agree, but they haven't agreed.
Yeah. It's got to be enacted here.
I suspect that there's lots of provincial satrapies, particularly in Quebec, that will want to be heard from. In the United States, we allegedly have a tripartite approval process, federal, state, and local. And any agency can, in certain circumstances, take lead agency status, which leads to some pretty ugly fights between the feds, the states, and the local around permitting. And I would suspect that our experience becomes the Canadian experience too. I would love it if it wasn't true.
We'll see.
Okay, coming up on the end here, guys. Rick, a question from our friend Scott Williamson, who we haven't seen in a while. Welcome, Scott. Asking about, are there any ETFs that are worth checking out that focus more on the aggressive junior oil and gas issuers?
The answer to that, Scott, is I'm sure they are, but I don't know them. My own objection to ETFs, having been the author of a couple at Sprott, is that too often ETFs have too broad a portfolio and not a narrow enough mandate, which means that you're paying a management fee to assemble a portfolio of stocks, half of which you wouldn't own rationally with a straight face. There's something inelegant about paying somebody to construct a portfolio that I don't like. And my own preference personally is to choose reasonably high quality companies, count on holding them for a long time, assemble a portfolio myself, and perhaps underperform, perhaps outperform the ETF. But at any rate, be responsible for my own mistakes.
Right. Okay. Let me see if I can get two more in. Diane is from Canada. Rick, she wants to know if you think Mr. Poilievre would be able to negotiate with Mr. Trump if it came to a conservative government.
I don't suspect Mr. Poilievre will actually have to do that. Mr. Trump has chosen to pick 200 fights at once. Having been a fighter myself, the probability that I would have ever won a fight against 200 opponents is very low. Usually winners pick a fight, win it, then pick a second fight, win it, pick a third fight, win it. My suspicion is that most of the fights that Mr. Trump are picking are fights that he's picked in the context of his book, The Art of the Deal, which is to say he makes life very, very, very unpleasant for his opponents. And then he caves to the extent that he needs to. And I suspect that the reality of Trump over 6 months will be much less than the theater that Mr. Trump is causing today. Meaning that I think that Mr. Poilievre or Mr. Carney, frankly, can, if they want to, wait Mr. Trump out, particularly with regards to hydrocarbons. The U.S. oil and gas industry has been a pretty good backer of Mr. Trump, as has U.S. oilfield service companies and U.S. transmission companies. And my suspicion is that the benefit that the U.S. industry will enjoy from the revival of Canadian production means that Mr. Trump has an incentive himself to be less onerous with regards to Canada than his current talking suggests he would be.
Right. Okay. Last question from Gene. The question is about hedging. Rick, what are your thoughts on producers hedging this year, specifically Birchcliff, Peyto?
In the case of Birchcliff and Peyto, they're such efficient producers that it actually pays them to hedge at these prices. But normally, I wouldn't like to see that. Normally, I think the natural gas price is going higher. In the case of both Birchcliff and Peyto, they have so many high-quality undeveloped locations that to the extent that they can sell gas forward at $4 AECO, I'm talking about $4 Canadian AECO, they can likely produce that gas all in for $1.25, $1.50. So they're generating better than 50% operating margins, even by forward selling gas at these low prices. So in the case of both of them, as a shareholder, while I don't necessarily favor it at these prices, I understand it and I accept it.
Okay. Yeah, so that's going to be it, guys. We're out of time. If you joined us late, we've been discussing oil and gas vis-a-vis this new newsletter that Rick and Paul have launched. Paul, where's the best place for people to get this newsletter? Because they can get it at ruralclassroom.com. We have it at Rural Investment Media if you're on Rick's list. Is there a best place to get this newsletter?
I guess there's various different ways of sort of reaching out to sort of Rick and Rural Investment Media through the classroom, etc. So, whatever email address you've got, use that, and we can get you on the list to on the main distribution list.
I would urge anybody listening to this who likes what we do to do it through the Rural Classroom. There are thousands of people at the Rural Classroom, and the goal of the Rural Classroom is to provide instructional material which will allow you to better manage your own portfolio. To that end, we would like the subscribers to the newsletter to join the Rural Classroom so that they can participate in interactive discussions like this, but more importantly, so that they can have their own discussions. If you have 10,000 brains, it's better to have 10,000 brains than 3. And we would like to foster discussions around each of the newsletters at the Rural Classroom. Discussions that will likely be better moderated and take place in a better context than they would through X or other mechanisms.
Yeah, I totally agree. So that's ruralclassroom.com. We have weekly lives there as well as additional guest experts coming in. And finally, if you want to catch up with Rick and Paul at the coming Rural Symposium in Boca Raton, Florida, I invite you to go to symposium.ruralclassroom.com and secure your ticket there. This could be in person or online.
If I could talk about that just a little bit, Albert.
Sure.
We talked a lot about politics, and the Rural Symposium this year is going to have as a keynote political speaker David Stockman, who ran the original Department of Government Efficiency under Reagan. He wrote a book called The Triumph of Politics that details the derailment of the Reagan Revolution by Republicans and Democrats in Congress within 6 months of the Reagan inauguration. Much more recently, he's written a book called How to Actually Cut $2 trillion from the U.S. Budget. There is nobody better placed to discuss the success or failure of the Department of Government Efficiency than David Stockman. This follows a long tradition of our conference to have big picture speakers who speak to you from the belly of the beast, not third-party commentators, but rather like Nomi Prinz, somebody who talks about the structure of Wall Street, having been a Goldman Sachs partner, Daniela DiMartino Booth, who talks to you about the Fed, having been a Fed researcher, Jim Rickards, who talks about the structure of Wall Street, having been general counsel of long-term capital management, who almost brought down Wall Street. Nobody better to talk about federal budget politics than the former director of the Office of Management and Budget, David Stockman. This conference has been going on for a very long time. It's been very successful. It's generated an awful lot of value. Whether you attend live or live stream, you'll have access to the conference recordings for a year. You'll need them. We're going to give you 50 hours of material in 4 days, more than you can assume. Pardon me, more than you could absorb. And so you'll have to play these recordings a couple more times. This conference, unlike any other conference that I know of on the planet, comes from with an absolute solid gold money back guarantee. Whether you attend live or live stream, if you don't think you got your money's worth, just email me and I'll give you your money back. Now, as Albert knows, 30 years of money back guarantees, we probably had to refund 0.1% of the tuitions we've charged. That notwithstanding, this financial education product comes to you with no financial risk to you. I wear it all.
That's awesome, Rick. Question everyone wants to know is, will you have your squeaky pen and will my mic be unmuted?
Albert, let me also add to Rick's plug for the conference. The next coming issues of the Rural Investment Media newsletter will include one on precious metals royalties. We'll put an issue out on that. We're going to put an issue out on M&A in the gold space. A number of the companies that we will talk about in both of those issues, both of those editions, will be participating in the Rural Symposium in Boca Raton. So a lot of possibilities for interaction there with some of the companies we are talking about.
All right, thank you. Visit us at symposium.rulclassroom.com for that registration information. All right, gentlemen, thank you very much. For all of the members, thank you for your great questions, and we will see you again very soon.
Thank you so much for causing this to occur, Albert.
Thank you.